Hi, I'm Chuck Gibson. This is Taking Stock with Art Jarvis, a bi-weekly discussion of what is happening in the economy, the world of finance, and personal investment with Art Jarvis. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Now here is Taking Stock. Well, welcome back again, Art Jarvis. Taking Stock, episode number 19. Thanks for being with us again today.
Happy to be here. Thanks for having me.
As always.
I do. I enjoy this. It's good for me.
Well, hopefully it's good for the listeners as well.
I hope so.
But I enjoy our chats, and I usually learn something. So if I'm learning something, I'm guessing others are learning something as well.
I hope so.
Of course, I know a lot less going in than some of the people, but that's a different story.
Well, you can always. There's always something new to learn, right?
Yeah, absolutely.
You stop learning, you're in trouble.
And of course, we know that the Kansas City Chiefs won the Super Bowl. We had all of our forecasting, which included that little wild card fun thing about some football, but we're talking finances. And so we'll be checking back in the future shows as the year goes by to think about some of the things that you forecast for this 2024 financial 12-month calendar year, because we know in the financial world it's all about the fiscal years and a month at a time or a quarter at a time.
Yeah, well, I mean, one of the predictions was the S&P 500 would hit 5,400 by the end of the year. Well, here we are in January. We were trying to get to 5,100. I didn't mean we were going to get to 5,400 all at once.
Well, and what I remember, and I appreciate the fact that when it hit the 5,000, or surpassed 5,000 last week, boom, I get a text message from Art Jarvis that says, "Hey," and I said, "Yeah, but 7,500," because that was the other part of your forecast was 7,500 by
2030.
2030,
yeah.
Right. I was trying to remember if it was 2030 or not 2025. Yeah. But it obviously it crossed that 5,000 threshold.
Couples got to cross it. And again, 5,000 is we talk a lot about the psychological part of investing, which is really a big chunk of it. I mean, there's numbers, and numbers kind of tell me where things normally should be. But yeah, just as psychology can drive and drag a market down way further than it needs to go, it can also push it higher than it needs to be. You kind of get into that fear of missing out and things like that. But yeah, I mean, the market was up 27%, and that was in like 4 months. It's and I said it before to you. There's a such thing as too far, too fast. Right. It's like let's not get ahead of ourselves.
Well, I haven't forgotten that you said that, because as soon as you said that it was up, and I was like, the too far, too fast issue. However, today, having had the forecast, and we'll look back at that as time passes, but today we're going to get back into some real numbers, what's happening right now, and then I know you want to talk about expectations. Yeah. So why don't we start there about some expectations for 2024?
Yeah, very much so. I think we kind of touched on last episode that, we were... they were looking for 2.2% gross domestic product, and we ended up with 3.3. So, once again, a big miss. But the interesting thing is that, back in October, November of 2023, all of a sudden we were, instead of talking about raising interest rates, all of a sudden the Fed was talking about decreasing rates 1 or 2 times in 2024. Which was great, because that was a positive surprise that people weren't expecting, and that really gave the market the kick that it needed to kind of start moving up, and all that money that was sitting on the sidelines to start going into the markets. Okay, well, the problem is now we went from, hey, we're going to have 1 or 2 rate decreases in 2024 to all of a sudden, several weeks later, we're talking about 6 or 7 rate decreases in 2024. And I think, we talked about and made the comment was, let's not get ahead of ourselves here. We still have some work to do. And, the pendulum for such a long time was swung over to the negative side. Well, you could just feel it and see it in volume and in the returns on the market. The pendulum was swinging to the other side, and we're getting just a little bit too far ahead of ourselves on the positive side. And since that time, the market has given us a couple gentle corrections to remind us that we're not going to get there tomorrow, right? It's going to take some time.
Right.
And one of the things was gross domestic product. It came in at 2.2. Well, they were looking for 2.2, but it came in at 3.3. So that's correction number one, that, okay, the market is still firing on all cylinders. The consumer is still in there participating and spending money. So as long as that's going on, we don't really need to decrease rates, right? We don't need to tap on the accelerator because we don't need any more gas. It's still cruising along. The interesting thing last week was like consumer.
The consumer price
index. Thank you. Yeah, CPI.
I told you, I have been learning things. And I'm glad you brought up the consumer price index, because that was something, it was in the news last week.
Yeah,
Big time. I heard a lot of talk about the CPI and, people who are talking about that versus the national debt. But I'll let you continue with your thought.
Well, the interesting thing is they were looking for that number to come in at like 2.9%. So that would have been the first time in a couple years that we saw the consumer price index or consumer inflation or retail inflation drop below that 3% mark. And I think I've mentioned to you numerous times that I use 3% inflation in my work, right? So if it's around 3, I'm kind of a happy camper, okay? It's not messing with my work too much. But the thing is 1 year ago in January, so January of 2023, we were at 6.4% inflation. By the end of that year, in December, we were at 3.4% inflation. Well, come for the January of this year, 2024 number, they were looking for 2.9. So they were basically looking for it to drop from 3.4 down to 2.9. Well, I think that's asking too much.
That's a whole half a percentage point in the space of what?
A month.
Yeah, right.
A month,
30
basically,
days,
from December to January.
Right.
And it's not a month over month, it's a year over year number, but it's still a cooling off of inflation. Well, we didn't get that number. We got 3.1, which upset the apple cart, right? So here the last few days, we've had the market down 0.5% this day, 0.5% that day, and things like that, but it kind of rallies back. But the point is let's not get ahead of ourselves. It's a good thing. 1 year ago, we were at 6.4. Today, we're at 3.1. 1 month ago, we were at 3.4. Today, we're at 3.1. Again, in my work, I look for the trends. I look at the numbers. And from my standpoint, if we went from 3.4 in December to 3.1 in January, I'm completely comfortable with that, and that's exactly what I want to see. Looking for 2.9, you don't want things to cool off too fast, because remember, the Fed is trying to negotiate what they call a soft landing. Right. They want to bring inflation down, but they don't want to blow up the economy. And every time I think about a soft landing, I think of like Elon Musk rockets, trying to land by itself on the thing, And that's another hour on the couch. But I mean, every hour, every time I see that, I think that's exactly, they're trying to bring that down and have a soft landing. They want to bring inflation down, but they don't want to kill the economy, right? So in my opinion, we are heading in that direction. We're doing a good job so far heading in that direction, but people's expectations have swung too far to the other side, and they're looking for more. And then when they're not getting more, they're getting, it's a negative report to them. It wasn't as much as they thought it was going to be. So,
well, I'm not going to tell the listeners to go back. Well, yes, I am.
Okay.
Go back. Go back and listen to each of the previous 18 Taking Stocks with Art Jarvis. They're available. You can find them on lovelandbeacon.com, but you can go to YouTube and search Taking Stock with Art Jarvis on YouTube, and you can go from episode number 1 all the way through the previous 18. You don't need to, but we would love it if you did and catch up. But my point right now is we've heard you talk about how they've talked about aiming for a soft landing. And you just touched on that again. But a soft landing, and I think you sort of said this, is like, well, I'll let you say it. So define a soft landing in terms of the economy from high inflation rates to bringing the economy back to a level playing field.
Yeah, if I'm Jerome Powell, the Fed chairman, or I'm the Federal Reserve, their definition would be, their target is they want to get inflation down to 2%, but they would really love to do that without sending the economy into a recession. I mean, that's basically a soft landing. If they can get it to 2% without pushing us into a recession, which was the absolute discussion for 2022, right? That's what beat us to death in 2022 was this, I'm going to get inflation down to 2% and I don't care if it pushes us into a recession. Well, he said that on a monthly basis almost, and every time he did, it sent the market into gyrations. So yeah, that's if you're trying to come up with a definition of a soft landing, the definition right now is 2% inflation without pushing the economy.
Well, understanding then, that definition. So the higher inflation rate, at again, like you said a year ago, 6.4%. What are the key factors that play into that increased inflation? And you don't want to create a recession when you're, grabbing that thing on your boat and reversing the engines to back up. What are the key significant factors that contribute to that rising inflation rate? What specifically does that?
Well, the definition of inflation is too many dollars chasing too few goods.
Right.
Okay, so it's a supply and demand thing. That's what inflation is. If you've got a very strong consumer base with a whole lot of money to spend, i.e. $6 trillion being pumped into the market,
right.
Then you have a completely messed up supply chain. Now you got a whole bunch of people with a bunch of money trying to chase things and trying to get things that might not exist at the moment. So that's the definition of inflation. It drives prices up. If all of a sudden there's a milk shortage or an egg shortage, the price of those things is going to go up, right? And I still have my X number of dollars that I want to use to buy eggs, right? And there's a whole bunch of people out there trying to buy a certain number of eggs, and they don't exist. Well, guess what? The price goes up. It's the same thing whether you're fixing your car or buying a steak or whatever that good is. So,
well, I had a method to my madness in going there, and this simplification, but backing that up. So what was happening is consumer spending. High consumer spending, or a lot of consumer dollars to be spent, and not a lot of goods to spend them on, because as you said, we heard and suffered this supply chain issue, whatever the reality was. So the point is, now we say the economy's doing okay because you and I keep looking out there and seeing cars in the parking lot at restaurants, cars in the parking lot at the grocery stores, cars in the lots of auto dealers.
Right. Lots of them, by the way.
So consumer spending, and so that soft landing is directly relative. So want the consumer spending to slow, but not to, as you said, recession levels.
Sure.
And where businesses are impacted greatly.
Exactly. And again, I personally, I kind of like that rocket coming down analogy because, rocket being inflation, okay, or the economy, however you want to look at it, you're cooling off. It's coming down, but you don't want it coming down so fast it crashes into the landing pad. You want it to have a nice, gentle setting down onto that. So it's a game. If that rocket's coming down too fast or the economy's coming down too fast, you need to tap on the accelerator a little bit just to kind of give it a gentle nudge so you don't push your way through that goal, so to speak. I'm trying to push an analogy here, but so that's what they're doing right now. At first, it was slam on the brakes. 2022 was cut. Raise rates 0.75%. Raise rates 0.75%. That is them stomping on the brake, right?
Right.
Now they're past the stomping on the brake. maybe the discussion was, okay, let's maybe raise rates another quarter. Well, they completely switched from that to raising rates another quarter to starting to talk about actually, instead of tapping on the brake, tapping on the accelerator.
Yeah, letting that foot off the brake.
Give a little, So that's now, they're now, instead of trying to drive inflation from 9% down, now they're in that, okay, we're trying to negotiate reasonable inflation, but also keeping the economy going.
Well, it equates with the raising of the interest rates, consumer confidence wanes.
That's
like,
true.
the value of the dollar gets in trouble, and the consumers start to worry. So, wait a minute. We don't want the consumers to lose confidence in our economy. So, like you let off the brake, you give a little pump on the pedal, and say, oh, you know what? Hey, it's okay. Spend. We're safe. That's Chuck's simplification of it, but I think that's what you're telling us.
Sure,
is just we got what a difficult balance it is in your business, maintaining. Investor confidence, consumer spending, the confidence of the consumer, the confidence of the investor. How is all of this impacting, the investors? I think what's interesting. And touching back again, so the first couple taking stocks of 2024, where we had some fun with your forecast, but you labeled it, you gave it a headline, bumpy, right?
Yeah, that's exactly
Was that
right.
it? Bumpy, bumpy,
and that's about what it's been for the last week or so.
I was going to say, in the last 7 days, all I kept thinking of, as we recorded the last episode, and you were saying, I know I said bumpy, and it looks like it does. Well, lo and behold, bumpy is exactly what it's been the last 8 days or whatever it is. You know.
This we've talked about this maybe once or twice before, but financial behavior or behavioral finance plays a huge part of this. Okay, and again, I don't have a psychology degree or anything like that, but it's people's brains have a lot to do with this, and there's the one always, I don't want to lose all my money, right? Well, something really, really bad has to happen in the world for you to lose all your money. Unless you're invested in something you clearly should not be invested in. But the other thing is the fear of missing out, and that's kind of where you had all this money sitting on the sideline, and we basically went from 4,200 on the S&P. Within a 2 or 3, call it a 3-month period, we went from 4,200 to 5,000. That's a big move, and that's the investor psychology. Because and the other thing is, I always like to point out is as human beings, we look at things like 5,000 is a psychological level. There's nothing new, there's nothing magical about it. It's just another number, but it's a psychological. We got to 5,000, we're too high. Well, why are we too high? If 4,990 wasn't too high, why is 5,000 too high?
Right.
So you got that. We look at calendar years. Nothing magical happens between December 31st and January 1st, but except in our minds, it's a brand new year, and there's all this possibility. Well, guess what? 2 days ago, there was still another 12 months ahead of us. It just wasn't. It was a nice little calendar year. So we look at we look at things differently, and and this, not to ramble on here, but it's like we talk about this if there's not a good reason for you to adjust your portfolio strategy, and the numbers aren't telling you that the world's coming to an end, you got to stick with the plan, because if you don't stick with the plan, you miss out on what happened between October 15th or whatever it was until January 31st. You missed a 20-something% return in the markets. Well, guess that's 2 or 3 years worth of returns. If you say the market gives you 9% per year, that's 2 or 3%. That's 2 or 3 years that you just missed out on.
Yeah, in a quarter.
Yeah,
Not
in
even
a quarter.
2 months really.
Exactly. So in a lot, not just investing and things like that. Our brains are very powerful tools, or whatever the word is. and they can be used where they do great things for us, or it can mess us up. You know, if we have fear, it can mess things up, right?
Yeah.
If you become greedy, it can cause you problems. And we're kind of in that, you know, we were too fearful. Things look like they are improving, so we just completely pushed the pendulum to the other side and got too greedy too quick. You know, hopefully the pendulum comes back a little bit, and we'll move forward this year. But again, it's going to gyrate. There's going to be some volatility this year.
Yeah. Well, those bumps in the market, do they reflect? You know, they probably do, but I'm going to let you explain it to somebody else that's out there like me that doesn't already know this. So, do those bumps in the market, you know, like what we've seen, jumps, falling down the last couple days especially, and then, of course, as you said, kind of regaining its footing by the end of the market day. But do those reflect like profit-taking, things like that? What?
Most certainly.
Yeah.
Yeah, I mean, that's part of, don't forget, there's a whole computer-generated market out there where billions and billions of shares are traded in seconds, based on certain algorithms and certain arbitrage opportunities and things.
Billions.
Oh, billions
of shares.
Easily. Yeah, definitely.
In seconds.
Nanoseconds.
I hate to hear that.
We have a friend who he's a computer engineer, and he works for a Wall Street firm, and he was talking to us that like his job is to keep these computers running efficiently. And he was telling us that it was literally millions and millions of dollars that would be lost in like 7 nanoseconds of a computer not reacting to a certain there's what these call arbitrage, and they're looking for situations where there's a opportunity to make a small amount of money. But if you're trading billions of shares, you know, if you're making a penny or a hundredth of a penny, you know, if you're trading billions of shares, guess what? You got yourself a nice little profit. So he was talking about the computers thing. So you'll see that at the end of the day. I always say the first 15 minutes, like from 9:30 to 9:45, and then from 3:45 to 4 o'clock, those are the least efficient times in the market. So I try not to buy and sell things in the first 15 minutes, and I try not to buy or sell things in the last 15 minutes of the day, just because things like that can cause the market to fly all over the place. It's not necessarily a accurate depiction of where we should be.
So we should record this show from like 8:45 to 9:15, or from 9 o'clock to 9:30, or whatever, or from 9:15 to 9:45, or something like that to keep you off of making any trades during that first 15
I try
minutes.
not. You know, every once in a while I might get a call at 3:50 and someone needs something, and guess what? We're going in and doing it. So, but yeah, it's. You know, people say, you know, we're having a great day or we're having a terrible day. And I was like, well, let's see what the end of the market brings. And I'm basically talking about that last 15, 20 minutes. A really ugly market can turn positive or vice versa in those last few minutes.
Well, in your business and with the clients that you have, and for so many people out there that, you know, may not be doing their investing with Jarvis Global, but with others like you, and then others like you that are out there hearing this, it's like, so what are you hearing now? I mean, do you, like on a daily basis or over the course of a week, do you get those calls that are like, hey, you know, I want to grab some money out of the market? Mm-hmm. Yeah. I mean, that's a regular thing.
That's a regular thing. I want money out of the market. I want money into the market, and you know, well, you want money into the market, but just a week or two ago, you told me you wanted your money out of the market. You know, it's like, okay, we're getting a little too focused on things. You know, that's why I tell you I look at things from a 12 to 18 month period out.
So people that are doing business like you are, Jarvis Global and other companies doing the same thing you are, you know that person, whoever it is that's going to call. Out of your clients, you're like, you know, you see something happening and you know that's a guy, he watches that or she watches that, so I'm going to get a call today. You kind of know it, right?
Mm-hmm. Yeah.
I mean, it's just a little fun side on, you know.
Well, that's the importance of communication.
Right.
So let's say the average person does not have to call you today and say, "I got to have $10,000 tomorrow." Right?
Well, I hope not.
Right. I mean,
yeah, right.
You generally know when some big ticket items is going to be coming your way, and that's you talk to your clients, and it's like, "Hey, I know within the next 6 months I'm going to buy a car, or
Right.
next 6 months I'm going to be buying a house." Well, that's my opportunity to go in. So let's say the market gets above 5,000, it's heading toward 5,100. If I know that I'm going to have X number of dollars for John Q, then I will raise that money on strength, as opposed to, hey, I got to have $10,000 and I'm at the mercy of the markets. Then, so it's a little bit advanced planning and things like that. So, you can do that.
Well, and I mean, I think that's a good, a sideways way to give a tip. So, asking Art Jarvis to pass a tip along. So, if there's a tip in that, it's that communication between you and your financial advisor, and you, the financial advisor, your communication with your client is so critical, so that that. I know, hey folks, sorry, but I have a financial advisor. We work with our financial advisor. I won't say whether it's Art Jarvis or somebody else, but that aside, I know those are communications we have. Sure. And I think the first time that it happened, is like, well, so, what? It was shocking in a session with our advisor to hear. So, like, what year's your car, and how long do you like to keep a car, and things like that. And he's leading to that. You're leading to that with your client. And hey, client, if you're not being asked that question and you're thinking about it, that communication is important. Hey, we need a roof, and we're going to need $10,000 or $15,000 to put a roof on our house, or we're going to do this remodeling project, and we're going to want to get that money somehow, maybe pull it out of investment funds. Those kinds of communications are key. So that's a tip: is share that information and give your client a chance to prepare, or client, give your advisor a chance to look. I think what you just said, seeing when it's at a strength to pull that money for your client, that's a big difference.
100%. Again, I always tell clients, not every client wants to tell you every single detail. Right. So I always say, the more I know, the better decisions we can make in the long run. It is that communication. And here's the beauty of where we are today compared to a year or so ago is, let's say the market goes up 20-something%, and I know this client needs $10,000 next month or in 3 months. Instead of going from trying to make 8 or 9, 10% in the stock market, then you take that money out and get conservative and drop all the way down to 0.5. Now we can buy a money market fund at 5 1/4. So, that's still 3 months of earning 5 1/4 or annually. Or, I can go in and buy a 3-month treasury bill with that money. And I know that if I buy it today, it's going to be at 100. So I know that from between today and 3 months from now, I'm going to make a certain amount of money. So we can still do things, just because that doesn't mean you have to shut. If we take money out of one area, that doesn't mean you have to turn off the engine and sit there and not go anywhere. Right. You can still make money, but you just do it more conservatively, right? So, and that's the thing. I mean, I have people that take money out of their accounts every single month, right? So, if we have a great big run, and I'm like, wow, we're just way ahead of ourselves right now. There's nothing stopping me from taking 3 or 6 months of money out of the stock market and putting it into a money market fund or some treasury bills or something. So I know they're still making money, their portfolio's still moving forward, but I know that money's protected for the next 3 or 6 months or whatever. So there's a lot to it. There really is. It's a chess match in many ways, and not always right. Just because the market's up 20% and it's too high doesn't mean it's not going to go up another 5%, because once you get that market, that psychology moving, but you're making an educated decision, and you're playing the markets, So,
well, we're going to stick with our plan, and that plan says that we just ran out of time.
Really, that was fast
for taking stock number 19. So, Art, listen, thank you so much for joining us today and sharing the insights and expectations. And even, I think we got a pretty good tip to close out with today.
Well, I appreciate it. Again, this is, hopefully this helps some people in some way, shape, or form. And honestly, this is good for me. It's good for me to have these conversations and stuff. It's many times it's kind of like going back to fundamentals, and that's a good thing. Always kind of, if you're getting ready for a game or a practice or something, what's the first thing you do? You do the fundamentals.
I eat.
Oh, yeah. Right.
I'm just kidding.
Unless you're a wrestler, and you don't eat.
Yeah, no, exactly, the exact opposite. It's all about nutrition, and this is the nutrition. This is the feeding for people's financial life.
I like that. Well, financial nutrition. I like that.
And we'll be back with some more financial feeding with Taking Stock number 20 coming up in 2 weeks from now. But for now, until then, thanks again.
Thank you. Appreciate it.
Thanks for joining us for this edition of Taking Stock with Art Jarvis. Join us again in 2 weeks for our next edition. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Jarvis Global Investments, LLC is a registered investment advisory firm. The advisor is not attempting to furnish personalized investment advice or services during this production. Individuals should fully investigate the appropriateness of any investment before investing. Past performance is no guarantee of future results. Investments may lose value.